Hey, if you're looking to start a non-emergency medical transportation business and you need a set of financial projections for a potential investor or lender, then you've come to the right place because we have built a financial projection spreadsheet template built specifically for non-emergency medical transportation businesses. And I'm going to walk you through how to fill that template out and how to create a set of 5-year projections. Now, a little bit of background first. My name is Adam Huxema. I'm the co-founder of Projection Hub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for all sorts of different businesses and industries. And today we're specifically focused on this medical transportation template. And I'm going to walk you through now how to fill that out. One thing you'll note is that we have put a link to purchase this template down in the description of the video below. And also, if you hang around to the end of the video, so thank you for sticking around to the end of the video, we're going to give you access to a coupon code that you can use during purchase of the template. So with that in mind, I'm going to go ahead and dive in. So we're kind of starting with the end in mind here. This is the profit and loss at a glance, or the at a glance tab, where you'll see a profit and loss at a glance section here. You'll see some summary data about the average number of vehicles that you have and total revenue and direct expenses per vehicle. You'll see some key ratios and graphs and charts. You'll also be able to see a 5-year cash flow statement, a 5-year income statement, and a 5-year balance sheet summary, as well as an income statement, cash flow, and balance sheet broken down by month for each of the 5 years. So you get that annual summary level data as well as the monthly breakdown as well. Now, in order to produce these reports, we have a little bit of work to do. We've got to go back to this input assumptions tab, and I'm going to walk you through all the different input tabs. Now, the first thing you need to know is that any of the cells that are highlighted in blue throughout the spreadsheet are assumptions that you can change without breaking anything in the model. So we've got an assumption of a start date of January 1st, 2024. We're assuming that we're going to invest $40,000 personally into the business to get it started. Now, you can add fixed assets like buildings. If you don't have a building, if you're just getting started, you can just leave this blank. But if you did have a building, you could say, let's maybe have a storage facility for maybe you have multiple vehicles, and maybe you have a, I don't know, $400,000 facility where you store all your vehicles. So you could enter that in here. But we're going to assume that we're just starting out with one vehicle and you're an owner operator. And so we're going to kind of start out small and go from there. Okay, so you can enter in the vehicles that you have down here. I've entered in 2 different vehicles as an example. So, a lot of times for a non-emergency medical transportation vehicle, you might have a wheelchair accessible van, a minivan perhaps. And so that's what we're kind of assuming here. You can either purchase or lease that vehicle. So I'm going to assume that we're purchasing it. And let's say we're buying it new for $55,000. We think it'll last us 10 years. And at the end of 10 years, the salvage cost, what it'll be worth after using it for 10 years will be $10,000. And we're going to set the purchase month as month 1. We're also assuming that we're going to get a loan. We're going to finance that vehicle. So we've got an assumption up here of 90%. So it's taking the purchase price times 0.9. We're assuming a 90% financing at 8% over 60 months. Now I have a second vehicle in here. So we're assuming maybe you get a larger vehicle of, a small bus or maybe even an ambulance or something that can carry someone on a stretcher or gurney. That may also be a use for non-emergency medical transportation vehicles. And so we're assuming that we buy that vehicle for $75,000 in month 13. So you can see you have the ability to add what month you're purchasing or starting to lease each vehicle. And again, we have the amount financed as 90%. And you have the ability to add in other loans, but we're going to assume that we don't have any other loans for the business. Okay, so now we're going to jump into the input revenue tab, and we'll see that it'll pipe in from the input assumptions tab the number of vehicles that you have in operation. So we'll see 1 vehicle here initially, but then once we get to month 13, that'll bump up to 2 as we get that second vehicle in operation up and running. And we'll say, how many days per week are you operating? So we're saying 5 days per week. The maximum number of trips per day we're assuming is 8, and the average number of miles per trip is 15. That will give us a maximum miles driven per day for our vans and either ambulance or bus vehicles. And we're going to start out, we're going to kind of separate the van work from the ambulance or larger vehicle work. And so we're going to start out with the non-emergency vans. And we're saying, okay, there's 120 miles per day that could be driven. What percentage of capacity is used by the vans? So we're saying 70% of that capacity is going to be used by those vans, okay? That means we're actually driving 84 miles a day, 1,825 miles a month. and an average revenue per mile of $3. And here we have this driver pay per mile. So you could add a driver pay per mile. Now, we're kind of assuming that you'll be an owner-operator in this example, and so you'll be driving and you won't need to pay yourself by the mile. You're just going to pay yourself the profit of the business, right? Now, you also have the ability to enter in a salaried position or salaried driver. And so I'll show you how to do that here shortly as well. So in that case, perhaps you're either paying yourself a salary or you're just the owner of the business, but you're not one of the drivers. So that is a possibility as well. All right, so now we have these variable costs per mile, and we're assuming 20 cents worth of fuel per mile. Now, this is obviously a very volatile number depending on the price of gas and depending on the fuel efficiency of your vehicle. So you'll need to do your own research on this. We also are assuming 4 cents per mile for repair and maintenance type costs, tires, replacement tires, that sort of thing. And you can add in additional variable costs per mile that are relevant to your specific situation. And that will forecast your revenue for the vans. Now we'll move into basically the same process, but for the buses or the ambulances, the larger vehicles. Now to start out with, it's going to say, okay, we have the number of miles available per day that we could drive. It's saying is 36. Where did it get that number? Well, it's coming from up here because it's saying in total we have 120 miles available to drive. 70% is being used by the vans. That means the remaining 36 miles is available to be driven by the larger vehicle. But in month 1, we don't have a bus or an ambulance yet, because if you remember back here, we said we're going to buy this bus in month 13. So we're saying we're using 0% of that capacity for the first 12 months, but then starting in month 13, once we get that vehicle, we're going to start using 60% of the available capacity. So again, that means we're not fully busy. We're going to be able to operate 60% of that available capacity. And we can add a growth rate to that, so we may grow that capacity that we get to use over time. That will calculate the number of actual miles driven per day by the bus or ambulance. The average revenue per mile, maybe that's a little bit higher for a larger vehicle. And then the variable cost, the fuel cost, the repair and maintenance costs also might be a little bit higher, so we put in 30 cents and 5 cents per mile for those repair and maintenance costs. And that will calculate our total revenue and cost of goods sold. Now, jumping over to our input other expenses, we will have some fixed expenses as well as other per vehicle expenses. So you can add in things like insurance. We've got a per vehicle, so you'll see this drop down here. You can either set it as a fixed dollar amount, meaning it's the same dollar amount each month, or a percentage of total revenue, or a per vehicle expense. So we're saying $125 worth of insurance cost per month per vehicle. Same thing with license plates and permits. Software, you'll probably need smart routing software. So we've got $50 per vehicle per month for that. And then just miscellaneous costs of $300 per month. All right, now we get to the salaries tab, and we're going to, as I mentioned, we could decide to add driver salary. So let's say we do have a driver salary for the van, $28,500, and for the bus of $30,000. And that bus driver will start in month 13. And then finally, that brings us back to the at a glance tab, where we have finished our set of projections, and we can see we're projected to be just slightly profitable there, $12,000, and that is after paying that driver salary. So if you are the driver, you get the salary plus the profit, right? So thank you for watching. As a thank you again, a coupon code. So you can go down to the description of the video below, and you'll see a link to fill out a form to get our most up-to-date coupon code. And that'll be emailed to you, and then you can use that at the checkout. There's also a link in the description of the video below to find a spot where you can buy the template and use that coupon code during checkout, and you'll get a discount as our thank you for watching this whole thing. So with that, if you have any questions, please don't hesitate to reach out and let us know how we can help. Best of luck as you get started. Thanks.